Hi guys, welcome to the first video in this new little series that I'm doing that was actually suggested by one of my Patreon members. And it's basically where I build example investment portfolios for different aims. So in today's video, we're going to kick it off by building a portfolio for someone that is looking for a diversified portfolio that will give them dividend income. In this portfolio I'm going to share with you today, I've included both UK dividend paying stocks and American and Canadian. So please note that if you did actually build this portfolio, there may be some extra FX fees and also some withholding tax on the dividends as well. But remember, this is just a really fun video idea. It's not financial advice whatsoever. And if you want to leave any suggestions for future portfolios to build, perhaps one for growth stocks, etc., leave them in the comments below. Wait until the end of the video as well, where I'll share exactly how much you'd be paid in dividends if you were to make this whole portfolio worth £10,000. So let's get into company number one. The first company is Unilever, which is a UK consumer good company. Let's take a look at how they've been performing, their dividend yield and their dividend history. Unilever have a dividend yield of about 3.5%, so a pretty decent one. And if we take a look at the dividend growth, you can see it's quite good here. Most years they've actually been able to increase their dividends every single year. If we scroll down, we can see a few years where they haven't actually been able to do that, 2021, 2015, but by large, they have been able to actually consecutively increase their dividends year on year, which is a really, really healthy sign for a dividend stock. Taking a look at the performance over the last 1 year, they're up by just under 25%. So an absolutely fantastic 1 year performance. If we expand that out to 5 years, not so great, but still up by just shy of 5%. We can see that they've had times where they were hit pretty hard. You know, in the last 5 years, a lot has happened. So it's not really surprising. But if we max it out, we can see how truly powerful this Dividend UK stock really is. So I've decided that this portfolio is going to be made up of 20% Unilever stock. And the reason for that is because it's a consumer goods company. It's not so volatile and it's always needed. People always need the products and people are pretty loyal to the brands that Unilever actually has. So I think 20% is a reasonable allocation to this stock. Next up is a company that I've decided to allocate 12% of the entire portfolio to, and that is National Grid, another UK dividend paying stock. National Grid is a utility company, one of the largest utility companies, and it focuses primarily on gas and electricity distribution and transmission. National Grid have a slightly higher dividend yield than Unilever at 5%, and if we take a look at their annual dividends, we can see a really, really strong picture here. Just scrolling down, they have managed to increase their dividends every single year for over a decade. That is pretty impressive. The 1 year performance of National Grid is not so amazing. They're down by 6.23%. Zoom it out to 5 years, a much nicer picture here, up by just short of 28%. So a really, really good 5 year performance. And if we max it out, you can see again, like Unilever, this is a stock that has been around for a very long time and has been doing very well over the long term. So if you're a long-term investor, this may be one to look at. The next company that is going to get a position in our portfolio today is Legal & General. Legal & General is within the financial services sector, specifically focusing on a lot of insurance products. Now, with this portfolio, I have tried where possible to be as diversified across many sectors as I possibly can. Of course, not all sectors have really high dividend yielding stocks, and you'll see that as we go through. But anyway, just like with National Grid, I've decided to allocate 12% of this portfolio to Legal & General. Now, this portfolio is for dividend yields, but I did want to include quality companies, not just ones with extremely high dividend yields that may then just cut them in a year's time. But Legal & General is one of those companies that does actually have a pretty high dividend yield. You can see here 8.9%, one of the highest that we're going to see in this portfolio today, which of course will push that overall dividend income up a little bit. Let's take a look at the dividend growth that this company has been able to sustain. So you can see 2010 to 2011, it decreased, but since then it looks like it's been going up, maybe a slight decrease. Oh no, that's the same. So yeah, it's been going up, but let's just take a look. Perfect. So since 2012, they have been able to increase their dividends every single year. In 2020, you can see that there's a 0% change. So they didn't manage to increase it, but given what was going on for that time, to keep it the same is still pretty impressive. Across a 1-year time period, the stock is down by 17.48%. Across a 5-year period, similar picture, down by 14.33%. But you see it's slightly nicer here if you max it out. They've had a few years where they haven't seen too much growth, but if you look before that, they saw loads of growth. So you've got to decide whether you think this is a company that are going to do well in the future. You don't want to be focusing on short-term volatility. You want to be thinking about whether this is a good allocation of your money in the future. You don't care really about the past when you're an investor, you care about the future. The next one that we're going to be having in our portfolio today is also within the financial sector, but it is not a UK stock. This one is a Canadian banking stock. If you know already, Canada have some amazing banking stocks. I think they have like 5 or 6 really big ones, but in the portfolio today is going to be TD Bank. And I'm going to allocate 12% of the entire portfolio to this company. So I'm currently on Seeking Alpha, which is the platform I've been using for the majority of my stock research recently. It tells you everything you need to know about each stock. It tells you the dividends, the dividend growth, earnings report, the financials, any analysis into the stock that people have done, the news, so the latest news on the company, literally everything you could need to know. I tend to use this platform for non-UK dividend stocks, but you can use it for them as well if you want to. So I will leave a link in the description to Seeking Alpha if you do want to try it out. I think they do like a free trial and stuff like that, so worth having a look into. So TD's dividend yield is 4.9%, just short of 4.9%, which is a pretty good dividend yield. You tend to see that most financial sector stocks actually do pay a dividend, but what you should look into alongside that is, are they able to sustain their dividend? Can they grow their dividend? And what's their stock performance like as well? So let's take a look at their dividend growth and dividend history. Clicking onto the dividend section here, it tells us that the dividend growth has been able to happen across 8 years. So for 8 years consecutively, they have been able to grow their dividends. Let's just click into the dividend growth section and scroll down. We can see it all written here if we want to go through it, but if you just want to see a graph, again, you can do that here. Stock split happened, it tells you, but anyway, they have been able to grow their dividends year on year, which again is a really great thing to see. Like I said, in this portfolio, we want high dividend yielding companies, but we're not going to pick them over good quality companies. We're going to get good quality dividend paying companies. So year to date, TD Bank haven't had such a great performance, but neither have any of the bank sectors. Like, we know what's going on right now. They are not doing so well. But if we look at 1 year, again, not great. Let's go to 5 years, a little bit of a better picture. And then if we start looking at 10 years and maxing it out, we can see that this is a great stock to have. Next up, we have a stock from the tech sector. Now, typically speaking, the tech sector doesn't really pay dividends. They tend to be more of the growth stocks. So if you are trying to have a dividend portfolio and you want exposure to the tech sector, you're going to have to be okay with having a stock that has a slightly lower dividend yield. So today, the stock that is making it into this portfolio is going to be Microsoft. And we are going to allocate Microsoft 10% of our portfolio. Like I was saying, tech companies that do pay a dividend don't pay a very high dividend because they're pumping most of their money back into growth. So the yield for Microsoft comes in at just under 1%, 0.98. So we're not going to be expecting loads of money to be generated in dividends for this company. But let's just go on to the dividend section and take a look here. So dividend growth, 10 years, we can see a very decent dividend growth picture. Going back to their performance, 1 year, not that great. 5 years, amazing. 10 years, incredible. This stock is a very powerful one indeed. You can see the absolute incredible run that Microsoft has had over its lifetime. Yes, it's dipped recently, but it seems to be going back up now. But yeah, fantastic picture here. The next sector that we're going to get exposure to in our portfolio is going to be the energy sector. And the company that I've picked to do this is Shell. I've decided that Shell is going to make up 10% of this portfolio. Shell's dividend yield is 4.1%. And if we scroll down and look at their annual dividends, you'll see that there's only 2 years showing here. And this has been a consecutive growth, but only for 2 years. And that's because I believe they've undergone like a name change, so it's not showing on this website. But I think previous to that, they've had some dividend cuts and stuff, but 2 consecutive years of growth. So not too amazing. Their dividend seems to be a little bit more volatile than others, but I thought this would be a good company to represent the energy sector in our portfolio today. Year to date, Shell have been down by 8%, 1 year up by 4.66%, 5 years down by 6.24%. We all know that the energy sector has been a little bit volatile and a little bit crazy in the last few years. The next company is a US REIT, and that is Vici Properties. So this US REIT, Vici Properties, actually owns and operates lots and lots of different style of real estate. So they have gaming, hospitality, casinos, hotels, centers, loads and loads of different types of properties, primarily in Vegas, but they also have them across the US and I believe maybe even in Canada as well. They have a good dividend yield at 5.2%. And if we look at their dividend history, we can see that they have been growing their dividends since they began paying dividends in 2018. So you can see here that every single year the dividends have been going up. So that's a really promising sign. Year to date, the stock is down by 5.5%. 1 year up by nearly 11%. 5 years, an amazing growth here, up by 65% across 5 years. And if we max it out, we can see that they began not that long ago, publicly being traded, but they've had a fantastic run apart from a massive dip in 2020, as did many companies. And I've allocated 9% of the portfolio to Vici Properties. The next one up is getting 8% of this portfolio, and that is Rio Tinto. Now, the reason I'm giving them quite a small percentage compared to some of the other companies is just because they are very volatile. They are a metals and mining company, and just by that alone, it tends to be pretty volatile, which then means that they have dividend cuts, they increase their dividends. It's a little bit all over the place. So I didn't want to give it a really large percentage of this portfolio, but I still wanted to include it because they are one of the big UK dividend payers. Rio's dividend yield right now on this website is showing as 7.8%, which is extremely high. And if we look at their annual dividends, you'll see what I mean by it being sometimes a little bit volatile in both stock price and dividends. They have been able to increase their dividends for quite a number of years, up until very recently when they actually had to cut them back slightly. Year to date, they are down by nearly 11%, 1 year down by again nearly 11%, 5 years, very good picture, 46.54%. And if we max it out, you'll see what I mean by this one being a volatile stock. You can see that they've just been up and down, up and down. So a little bit more of a risky move in a portfolio perhaps, but I still think a good one to have in this portfolio today. We now only have one position left to fill, and we're going to fill that with a telecommunication sector stock, none other than Vodafone. Vodafone's dividend yield again is very high, 8.7%, so that will bump up our dividend income from this portfolio, which I would never recommend ever picking stocks just based on a high dividend yield. I think that is a formula for failure. But this is just fun. We're not taking this too seriously. Annual dividends, you can see that they have had quite a long time period where they've been able to sustain and grow their dividends, but they've also had periods of time where they've had to, almost half their dividend payout. And you can see that a little bit clearer here, that up until 2018, they were on a bit of a run, and then they've had to cut them back slightly. They're still paying a dividend, but not as big. Taking a look at the stock performance, year to date, they're actually up, not by a great percentage, 3.43%. 1 year, completely different picture, down by nearly 29%. 5 years, again, not a great picture, down by 56%. Max it out, it looks slightly better, but you can see that they've been trending down for quite a number of years now. And that's why I would say don't pick a stock just based on its dividend yield, because maybe they're not seeing very much growth, but that's something just to think about when you're actually building a real portfolio. So on the screen now is all of the companies that I've put into this portfolio and their allocation. So if you want to pause that and just have a look through it, feel free. But now I'm going to move on to the pie. Here is the portfolio we've just built as a pie. So you can see exactly how much of that 10,000 that we spoke about at the beginning would go into each of these positions. So like I said, I was allocating 20% of the portfolio to Unilever, which means that Unilever will have £2,000 in that stock. National Grid, 1,200. Rio Tinto 800, Shell 1000, Legal and General 1200, Vodafone 700, which is going to be our smallest position in the portfolio, Vici Properties 900, Microsoft 1000, and TD Bank 1200. Hopefully, if my maths is correct, all of that adds together to give a £10,000 portfolio. So now let's see how much you would actually make from this portfolio. So which companies would pay you in which months and how much you would make from those companies across an entire year. So the first company that will pay you in this portfolio is going to be National Grid. National Grid paid twice a year, once in January and once in August. At the current share price, with the amount of money that we are pretending to put in this company, you would actually give yourself about 114 shares of National Grid. Now, like I said, this portfolio building is just for fun, so I'm not considering any FX fees, any commission fees, anything like that. We're just keeping it really, really simple. So across these two payments, National Grid would pay you £58.11. Moving on to the next company, which is Vici Properties, you're going to get 4 payments for this one. You're going to get January, April, July, and October. The share price of Vici Properties right now is about $30, which works out to be about £24.63, which means with the money that we have allocated to this position, you would pick up about 36.5 shares. This means across the year, you would be paid £43.91 in British pounds for Vici Properties. Next up, we have TD Bank. TD Bank are going to pay you 4 times a year. They're going to pay you in January, April, July, and again in October, exactly the same as we saw with Vici Properties. TD Bank is about $56.35 per share, which is about $46.20 in British pounds, and that will get you around 30 shares. So across the entire year, TD Bank is going to pay you £63.47. The next company we have is Vodafone. Vodafone are going to pay you twice across a year, once in February and once in August. Vodafone is currently at about 89p per share, so a very, very low cost per share, which means with our allocation, we can actually pick up 786.5 shares. And this means across the entire year, Vodafone will pay us £59.33. Next up, we have got Shell. Shell are going to pay you in March and in June and in September and in December, so 4 times across the year. Shell's current share price at time of filming sits at $21.76. This means with our allocation, we can pick up 46 shares of Shell. That's a mouthful. So across the year, we're going to get paid £37 and a penny from this position. Now we've got Microsoft. Microsoft is going to pay us 4 times a year in March, June, September, and December. Like we saw, Microsoft's dividend yield is really quite low at just under 1%, so don't expect crazy things here. We're going to be able to only pick up 4.4 shares of this position because Microsoft is a lot more expensive per share than, say, Vodafone, which came in at 89p. So we can pick up 4.4 shares, and across the year, we're going to get paid £9.15. Moving on, we have Unilever. Unilever are a quarterly dividend paying stock as well. They're going to pay you in March, June, September, and December. What I should just quickly say, which I forgot to say, is that we're basing these numbers on last year's dividend payouts. Unilever is currently at £41.80 per share, which means we can pick up 48 shares, meaning across the year, Unilever are going to pay us £69.83. Next up, we have Rio Tinto. Rio Tinto are going to pay us twice across the year, once in April and then again in September. At the current share price and with our allocation, we're going to be able to pick up 15.5 shares of Rio Tinto. And like I said, based on last year's dividend payouts, we're going to get £88.96. But as far as I remember, they did have a special final payment, so of course, this is just for fun. This is not necessarily what it's going to be next year because you hope that dividend yields will go up over time. And now we have Legal and General. They are going to pay you twice across the year, once in June and then once in September. Legal and General are currently costing £2.24 per share. This means that with our allocation, we can actually pick up 536 shares. Across the year, Legal and General are going to pay you £100.30. So this entire portfolio would pay you £492.77 in dividends across a 1-year period. That is with £10,000 being invested, But of course, with dividend growth investing, ideally you want to be reinvesting your dividends and growing the amount you get paid every single year. So that was a really fun video. I hope you enjoyed that. And if you want to leave any more suggestions of portfolios that you want to challenge me to build, please leave them in the comments below and I'll definitely take a look at that. And if you want to become a Patreon and join the Discord and talk to me every day about my portfolio, your portfolio, anything else to do with investing and personal finance, again, I'll leave a link in the description. Hope to see some of you guys there. Thank you so much for watching and I'll see you in another video very soon.